This is going to be a stock analysis update for IGas. IGas claim to have enough shale gas resources to supply the whole of the UK for 9 years, and with recent support by Liz Truss and Mr Sunak that they're going to lift the ban on fracking, the share price for IGas has gone absolutely ballistic in the last month. Before I start, however, please remember that I only do these videos because it's a hobby of mine, and because everyone's situation is different, you should always consult a qualified financial advisor before making any investments. When I first started looking at IGas, my first surprise was that actually 88% of their revenues currently come from oil production, and that actually in the UK there are hundreds of these oil pumps scattered around the country which are producing onshore oil, like in Texas or somewhere. Here's an example of one. It's interesting to see how they're hidden away as if they were a concentration camp. Most people driving by wouldn't even realize it was there. And that just goes to show how demonized the oil and gas industry is. So the company is currently producing about 2,000 barrel of oil equivalents per day, but the cost of their production is very high. And as we can see, they've actually been losing a lot of money every year. That's why they hedge a lot of their oil, which then enables them to get money off, which then enables them to use that oil as collateral so that they can have a reserve-based debt facility that really keeps them going. The vast majority of all their current operations are onshore oil production, and it tends to be older oil wells where there's not much oil left, and they're pumping loads of water in to extract the last bits of oil you can get, a bit like scraping the barrel. Because of their high cost of production, that's why they've been losing a lot of money since before 2015. And really, they are currently a bit of a zombie company. They also have vast shale gas exploration licenses, though, and these are based where their oil assets are based, and in the northwest and in the East Midlands, particularly in North Nottinghamshire. Currently, though, there's a ban on fracking in the UK, effectively, plus a lot of opposition, and local councils never give planning permission to do shale gas projects. This shale gas they have won't be able to actually develop until you get some kind of act of parliament or something, because there's an energy crisis, then forcing the local councils to let the fracking go ahead. Having said that, they claim to own 27 trillion cubic feet of recoverable gas resources, and that would be enough to supply the whole of the UK for 9 years. I did a back of a beer mat calculation, which you can see here if you want to check that I've not got that wrong, which I could have done. But according to me, based on, I actually used 2019 gas prices, which are $5, and they're now much higher than that, 6 or 7 times plus higher than that. But even if we assume 2019 prices, I then calculated that that means they've got access to 139 billion pounds worth of gas. And then if you assumed that it was really expensive to extract, so that they only made a profit of 10% of that, that still gives you 13.9 billion of gas resources that they may be able to access. And when you compare their current market cap, this was when I measured it a week ago, but it's actually not far different to that now. If you compare their market cap here with the value of 10% of that gas that they claim to have, you can see that the potential upside for this company is absolutely astounding. So I do look at this as a intriguing asymmetrical bet opportunity. When you look at their recent share price, it's racy enough as it is with to go in now after it's already done that. But to get better context, if you zoom out 10 years, then you see a completely different picture. And actually, this here is the classic profile of a zombie company. which does then illustrate the risk there is with this company, particularly when it's just done that. So here we have the UK oil price, and you can see that up until about 2014, it was around $100 a barrel. And then it suddenly fell to about $50, $60 a barrel from 2014. And so that corresponds nicely with the IGas share price crashing. Like I say, these are older wells. They have to pump loads of water in to get that last oil out. And so they have a very high production cost compared with North Sea oil and stuff like that. So when the price of oil crashed, they really then started losing a lot of money, as you can see here with these numbers, like we're talking 50 million a year. So that explains the this zombie profile. And actually, they were about to go bankrupt, but then in 2017 there was a capital restructuring. Kerrigan Capital were the brainchilds of it, and they ended up then with 28% of the company. But in this capital restructuring, most of the debt holders took a haircut essentially on their debt by exchanging it for equity, and then that then allowed the company to continue, as far as I'm concerned, as a zombie company, but without the threat of immediate bankruptcy. Also, bear in mind that they did a share price consolidation as part of that capital restructuring. So actually, if you were to take account of that, the share price now will be something like 8p rather than 80p. Then when we move forward to 2018, the government all of a sudden announced support for fracking. You can see here from a UK Parliament document that UK is becoming increasingly, this is dated from 2016 and it's only got worse since, but the UK is becoming ever more dependent on importing its energy, oil and gas. And we're now quite a bad net importer, when of course in the roaring 80s and 90s we had the benefit of actually being a exporter of oil and gas. So the government knew that it would be in our interests to allow fracking to improve our energy security and lower the costs for UK households when they try and heat their houses. And then in 2019, IGas announced at their Spring Road well that they had world-class resources, and it's only one data point, but it's from that they then calculated that they could have 27 trillion cubic feet of gas. However, only a year after announcing its support, the government then announced a fracking ban. And in a statement, IGas pointed out that they still had 160 million NPV10 of existing reserves, mostly oil reserves, so that they weren't bankrupt immediately because of that. And they pointed out that the UK as a whole has enough shale gas to provide the UK with all its gas needs for 19 years. So then after this fracking ban, we then get a series of green energy related announcements. They first announced in 2020 that they'd bought GT Energy, which is a geothermal project in Stoke-on-Trent. They then announced some hydrogen projects in Surrey. And then in 2021, they announced a memorandum of understanding with Scottish and Southern Electricity, whereas IGas would be producing this geothermal energy, and then SSE would be then distributing it to local schools and businesses. And then later in 2021, they announced a head of terms agreement with Iona Capital to build a 50 megawatt solar project in the UK. And then at the beginning of this year, they announced a heads of terms with Cornish Lithium for where they would be doing some geothermal projects in Cornwall, where you produce localized geothermal energy, and at the same time Cornish Lithium could extract lithium from the water. So the fact is, though, to me, they have all this time been a zombie company on the, really kind of under a lot of financial risk. And I just regard all this as because of the fracking ban, in order to save themselves with their shareholders, they just scrambled around them, rebranding themselves as a green energy company, just to try and save themselves because they were obviously under such financial duress. The actual amount of money to be gained from these announced projects are, from my estimation, not really that material against the company's current revenues. However, things have all of a sudden in 2022 changed. First of all, we had the energy crisis really break out this year. In response to that, the UK government asked the British Geological Survey to do a scientific review of shale gas. And then in 5th of July, the British Geological Survey provided this report to the UK government. And then ever since then, the share price has gone absolutely ballistic. More importantly, though, in the recent Conservative leadership elections in the UK, both of the leading candidates, Liz Truss and Mr. Sunak, have announced their support for fracking. And so this then corresponds with the share price going up. And personally, I suspect that even though this report is not actually available in the public domain, and I've certainly not been able to see details of it, Liz Truss and Mr. Sunak obviously have seen that report, or have been advised on the outcome of that report, because I think that's the reason why they're prepared to then support fracking on TV as part of the Conservative Party leadership elections. Okay, so looking at their conventional assets, this is actually a shale gas geological map, but you tend to find oil in the same areas, and the red dots here within the geological formations then correspond with the IGas oil fields. You see that they have them in the East Midlands here, and then also down in the World Basin down here. And there were actually two projects announced recently where they're using water flooding to extract oil from some new fields that you see here. There is a development of new reserves taking place. And so you can see their reserves here generally, they're not really in decline too badly. That's partly because of them developing new projects. But looking at their reserves, they've certainly got enough to last quite a while. I mean, that was one worry. Are they imminently going to run out? But no. I've got a typical year's attrition here, that little yellow box there, and you can see they've got plenty of oil to keep them going for at least a good 10 years, I'd think. Is shale gas geology in the UK, and IGas have shale gas resources that are on their books in three areas: the Weald Basin down here, the Gainsborough Trough here, and the Cheshire Basin here. They've previously done 4 shale gas projects. The first was in the Cheshire Basin at Ince Marshes in 2017, but they were refused planning permission. They then tried Ellesmere Port 1, and that again was refused planning permission. Then in 2018, at Tinker Lane in northern Nottinghamshire, they did a shale gas well, but it was a duster. But the purpose of that well was to find where the limits of the resource were, so that's not so bad that it was a duster. But then their fourth and final well was in 2019, and this was an exploration well at Springs Road in northern Nottinghamshire. It's just below Doncaster, and this resulted in the discovery of a world-class resource. And it was on the basis of that they are now predicting this large amount of shale gas resources they believe they have. This is from one of their investor presentations, and this is from that Springs Road drill. It's the actual the drill core. It's some of the core material they took from deep down in the earth to analyze, and it's been put in a water bath, and you can see gas liberating from the rock immediately the moment they put it in the water bath. And they show it has about over 2% of gas content in it. And in all these technical indicators that they had tested by experts in the US, where obviously they do a lot of shale stuff, according to them, this is a world-class resource. So I'm now going to look at the history of fracking in the UK and a bit more the technical challenges. So in 2010, Cordrilla drilled the first shale exploration well near Blackpool. This then led, however, to earthquakes up to 2.3 on the Richter scale, which led to the government banning shale testing for 18 months. And then robust regulatory guidelines were set up as a result of that. And this included a traffic light system. So now if you go above 0.5 in the Richter scale, then you have to stop all operations for a bit and have a bit of a risk assessment. So then in 2017, Cordrilla did a new exploration, did some horizontal frac test wells, which were called the Preston New Road 1 and 2 projects, also near Blackpool. And then in 2018, the UK government issued a written ministerial statement supporting fracking. However, in 2019, Cordrilla started to frack the Preston Road well, and then there were a load of earthquakes up to 2.9 of the Richter scale, and then the project was halted. And the North Sea Transition Authority was released a fracking report, which then led to a ban on fracking. So unfortunately, this frac testing led to earthquakes of up to 2.9 on the Richter scale, and then the project was halted. I've got some details here from one of the government reports on that, where you can actually see here where the earthquakes were. There's also the actual data, and here you can see all the earthquakes in amber and red, and a number of them were above the limit in this traffic light system. Now, to put all this into context, though, that limit is 0.5 on the Richter scale. The worst earthquake there was 2.9. Which would just be like a lorry going by your house. The limit's at 0.5, but even at 1.5, you can't even perceive the earthquake. There's been lots of arguments that this is actually set too low. I certainly don't think they should be doing any more fracking near Blackpool based on these results, but I do think that limit could be raised without risking going into the areas where you're going to damage property. And there's been lots of arguments about, for example, when people do coal mining and stuff, you get earthquakes. So really the limits for this should be more in line with that. And interestingly, I was doing some research into geothermal, where you also drill into the earth. And apparently on this project in Basel, there the limit was 2.9. So that's about 6 times what the limit is in the UK. So I find that very interesting that if you're doing a geothermal well, you're allowed a limit of 2.9 on the Richter scale, whereas if you're doing a shale gas well, you're only allowed 0.5 on the Richter scale. That's very interesting. So really, I don't think it's sensible to be doing drilling and fracking though somewhere like here, but perhaps where the geology is better and you could have a slightly higher level and still not really get any structural damage. I think seems reasonable. I haven't heard any reports that there were any major earthquakes where IGas have done their fracking, and they do claim that the Gainsborough Trail is better geology with less earthquakes. However, all the same, there is risk that IGas won't be able to do their drilling because it starts earthquakes. But it's an unknown risk as what the chances really are of that. Another point is that whereas in the US where shale gas has been successful, you have the same geology for large areas. In the UK, we have really complex geology, as you can see here, with lots of plate shifts and lots of fault lines. And here you've got a fracking drill, and you can see how they have to go horizontal to then do the fracking. So with all these fault lines, differences in geology, that then becomes a lot more difficult than would be in America. So that we have the question. I mean, currently there's not been any properly developed fracking experiments horizontally in flow tests. So it's an unknown whether fracking is even technically feasible or not in the UK. So anyway, the UK had banned fracking in 2019, and that was quasi quarteng for the Department of Business, Energy and Industrial Strategy. I guess they're kind of a level above the North Sea Transition Authority, and they're more closer to central government to direct what goes on. Of course, in 2019, that was when oil and gas prices were relatively lower, and oil and gas was also hated, and the governments believed that they could run a modern civilization by building some solar panels and some wind farms. But of course, in 2021 and then this year, it's emerged that we have a energy crisis. Now that's been blamed on Russia at the moment, but based on my research, look at the videos I did on commodities and on green energy, which I did in 2020 and 2021. It's actually the government's fault for us having a really bad energy crisis at the moment. The Russian problem made it worse, but we were still going to have a really bad energy crisis anyway, quite simply because, just like with the fracking ban here, back in 2019 and 2020, governments hated oil and they hated gas, and also all of the asset managers and pension funds and stuff. They really treated the oil and gas industry as a pariah, and so there just hasn't been enough investment in oil and gas. And so, even though we've got just as much oil and gas being used in the world, there's just not enough supply, and that supply takes 5 to 10 years to develop. So that's why we've got the energy crisis. It's the government's fault because of their energy policy in recent years. And anyway, because of this energy policy caused by the government, they then asked this guy, Kwasi Kwarteng, the same guy who banned fracking before, then wrote a letter to the British Geological Survey to advise on fracking. And then this report was submitted on the 5th of July 22. And like I say, I've not seen in the public domain the contents of that report, but Liz Truss and Mr. Sunak obviously have, because they've been going around on TV saying that they support fracking now. So to summarise the shale gas part of IGas, there is tremendous upside, but before they can achieve that, first of all, you need something like an act of parliament to allow it to happen. Because when I went on the Drill or Drop website and looked at what's been going on, all the different gas sites, you can see that most of the time the local governments don't even give planning permission. So first of all, you've got to have like an act of parliament to force the local councils to give planning permission. Then you've got to go through all of the protesters and stuff. I really do imagine Liz Truss being something like Margaret Thatcher during the miners' strike. And then, even then, you've still got the problem of, is it technically feasible? They get to do all the drilling they need, but then they find when they start to do the fracking, it's just technically either because of earthquakes or because of the geology. So it really is clear that although there is a lot of upside, this really is a very risky investment. So now to look at geothermal. And geothermal is a really good fit for IGas because because IGas are experts at drilling holes in the earth. And for geothermal, that's all you do is you drill holes and then the hot water comes up, and then you use that to heat houses. Now in 2020 they bought GT Energy to acquire a geothermal project in Stoke-on-Trent. That cost £500,000 plus up to 12 million in cash and shares that will be needed later. And then in 2021 they got planning permission. It's amazing how quickly you get planning permission for a geothermal project compared with a shale gas project. And then they got a memorandum of understanding signed with Scottish and Southern Electricity. In this deal, SSE will offtake the heat from the heat exchanger, which IGas will be creating. There are still steps coming up. They want to get a government grant for it to go ahead, but there is this government free money going. There's this Green Heat Network Fund where the government's going to give 50% of taxpayers free money to anyone who wants to develop a geothermal project. And then, assuming that happens, which I'm sure it will, the financial close is targeted for Q4 this year. Now, they also have projects in Manchester, Lincoln, and a Cornish lithium project, which I've already explained earlier. The thing is, geothermal is an excellent fit for IGas because they have the expertise of drilling holes in the earth. But the thing is, materially, I don't think it makes any difference to whether IGas go broke or not. And then looking at the hydrogen, they have a memorandum of understanding with Biotech, which is to develop blue hydrogen, which at their localized gas well sites, they'll be producing blue hydrogen there. And then they've got this solar project, but it's only up to 40 megawatts, which really is nothing at all. So, like I said, all of these green stuff, this was just chaff when the company was in a real bad way. The fact is, it's not really going to have a material impact on the future of the company. It's quite clear that the company will continue, at worst case, to just drop to its baseline. That can go along for probably a good 5 to 10 years, maybe. But all the same, you're relying on the shale gas to see permanent gains. All of this green stuff, it's just chaff and won't have a material impact on the future prospects of the business, in my opinion. Okay, so now on to their income statement. And generally, like I've said, they've had a real problem with just how much money they're losing every year off their current operations. Also, generally, when you see all these anomalies like this, whenever I do these profiles, that tends to be a sign of an ill company. One thing to note in the income is that in 2020 there was a big drop in their revenues. That was, of course, because of the world famous drop in oil price during the COVID crisis. The only other thing I picked out here was they had a 5 million gain from that restructuring they did in 2017. And another interesting thing is their tax credit, which come in as a income. So because they're producing oil and gas, which is needed for national security, but they're making a big loss every year, that then allows them to claim tax credits by not paying the tax on the oil they sell until some point in the future. And that then comes onto their balance sheet, their deferred tax assets. So that's an interesting income, but not really what I regard a high quality kind of income. And then looking at their expenditure, the cost of goods is actually really quite stable here at around 20 million a year. There's a lot of lumpy expenses though, which are one-offs, which then make the overall numbers here look worse than perhaps they could be. This 9 million operating loss is probably really a kind of adjusted what it could have been these previous years, but they had in 2018 they had a exploration write-off, and this was where they actually wrote off some of their conventional assets. Then in 2019, following the government memorandum banning fracking, they wrote off a load of their shale assets, which is this 54 million here. But that is actually only some assets they had, some shell assets they had up in Scotland. They've still got their East Midlands and Northwest shell resources in their books. And then, of course, in 2021, the Tinker Lane shell drill was a duster, and so they wrote off those exploration assets at 10 million. And in 2020, there was a lot of impairments, and the total went to 39 million. But much of that was impairments related to the oil price. So they downgraded the value of their oil reserves as a result in the drop of oil price. And of course, they will be able to, maybe even in the next financial report or in ones coming up, because I know that Shell have upgraded their assumptions for the future price of oil. I think they've done it from $60 up to 70. And so IGas can also, because of the energy crisis and expected longer term higher oil prices, they'll actually be able to reverse those impairments in the future. You know, you see they have these really lumpy expenses, often based to write-offs, even write-offs of their conventional assets. So, you know, it really does make for an ugly set of books. Now, I have to say, though, that despite all that, of course, the price of oil has gone up a lot this year. I took a look at Shell's average Brent crude price for the first half, and it came to $108. So, assuming the average this year is going to be $108, I did some very rough calculations here. If I'm right, I saw them bringing in over 40 million in oil revenues this year based on those higher oil prices. So if you then add that 10 million, and then if you assume, you know, we had this Tinker Lane write-off, if you assume there aren't any write-offs as well, then they could actually turn a profit this year at these high oil prices. Something to say though is that, you know, you want to be investing in a company that's like Shell or Total Energies, where even at $70 oil, they're still making quite decent profits. And then these bigger oil prices just mean mega bigger profits. That's much better than with IGas, where they're basically relying on an energy crisis just to break even. So here's my net income history, which, you know, doesn't look that great because, you know, this is the normal at $70 gas, $70 oil, and they might just be making a profit while there's an energy crisis. But how much scope is there for that for the gap between the income and expenditure to widen? So looking at their assets, and you can see their assets drop here from 2019 quite considerably. That's a result of those write-offs in both their conventional and shell assets. Also, there was a impairment on their property, plant, and equipment. A lot of that was because of the oil price drop in 2020. We have the deferred tax assets, and you can see how these are growing. A large amount of their assets are deferred tax assets, which isn't really quality assets in my regard. In terms of current assets, nothing's particularly significant, other than you can see that their cash is dwindling away. You know, this here looks like the profile of a distressed company. Looking at their liabilities, a positive thing is you can see here how their capital restructuring transformed their debt position. They were over 100 million in debt, and now they're only down to 14. So that's positive. And actually, they announced that because of the high oil prices, they've been paying off their debts, and they've got good cash flow this year so far. And they actually paid off 4 million of that debt by the end of the first half. A interesting and worrying thing is their provisions. Now, this is where once they've finished extracting oil from those oil properties, they then have to restore those properties, restore them in a environmentally friendly way, and then they plant trees there and stuff and turn it into a beautiful meadow and stuff. But that costs money, and so you can see how their provisions are building up. They they'll do the basic closing of the wells when they're finished producing so that they're safe, but they put off the full decommissioning, obviously because they just haven't got money to do it. And so you can see this kind of sitting time bomb of future costs they're going to have to make when they get the money somehow building up. And so that is actually quite worrying because it actually represents the majority of their liabilities. So when I've put their assets into a nice chart here, again, it's worrying that such a big chunk, nearly a third of their assets are deferred tax assets. And also interestingly, about are a quarter are actually their shale gas exploration licenses, and work they've done on them already. So this is worrying because shale gas is the question mark still, and so it's not good to have that as so much of your assets. So really, these assets are really a high percentage of their total assets here are fairly low quality, in my opinion. And when you look at their debt, again, you see the provisions here are the majority, and I think that's kind of could be like a hidden problem with this company. They're having to put off spending money on that. It's not a nice thing to have hanging around in the long term. And it's notable that their price to book is not that great. Now, I guess they don't make any money, so you can't give them a price to E. But when you look at their price to book value, it's it's slightly more than Shell and Total Energies here. So why would you spend money on buying IGas, who are really risky and haven't made any money for ages and and distressed state? Why would you invest in IGas when you could invest in Shell or Total Energies, which are high quality companies who are making twice as much money as they did last year and who are paying massive dividends? The reason why they've got quite a high price to book, despite being in a distressed situation, is because of a lot of the people are investing in them in speculation that shale gas is going to be a thing. And you can see here long term their market cap, and you can see how it crashed. I mean, they were probably quite overvalued here, really, but it crashed, and the assets overwhelmed the market cap, and that's because they were on the verge of bankruptcy. You can see their net loss every year. If I zoom into just the last few years, it's this fairly hideous net loss. Now, oil prices went up last year, and you can see it go up, and it's going to go up and be. I think there's a good chance they could be not treading water anymore next year because of the high oil prices. And when you compare their market cap, you see that in consideration of that, if you've been betting on the high oil prices, they were actually probably fairly valued here in terms of their income anyway, or their market cap versus their income, and certainly against their net asset. But then now that in the last month there've been a lot of interest, you can see how their market caps jumped up now, and their market cap is higher than their net assets. And like I say, they're now valued the same or slightly worse than a Shell or a BP, and that's the back on their shale gas resources. Just as a side note, look at how the value of BAE Systems has jumped up in terms of their price to book, and that happened because of the war in Ukraine. So looking at the shareholders, and this is very interesting because, well, first of all, you can see Caragen. They're the guys who were the main part behind the capital restructuring. Most of these other shares will be large institutional asset holders and stuff. But there's some good big names here. And when I looked at the recent activity, we see that although Geothermal actually sold half their shares this year, twice as many shares were bought by big players above 3% than sold. And we see Ode Asset Management came in and JP Morgan Chase came in and they bought 6 million shares each. Okay, so spoiler alert, I actually bought some IGas a couple of weeks ago, and they were around the time I bought them. There were a load of RNSs on the these. This was the date that the RNSs were announced, but on the 24th of August, it was announced that JP Morgan Chase had bought 5% of the company. And that was actually the straw on the camel's back that then prompted me to go and buy. Then on the 26th of August, it was announced that Ode Asset Management had bought 6%. And then on the 31st of August, it was announced that JP Morgan had actually bought another 1%. So it's very interesting to see these big names snapping up IGas right at this moment, right at this juncture. When I looked at the RNSs and tried to estimate what kind of price they paid for them, and I estimate it something around here. Maybe they'd bought them over a period of time, so they've bought them actually. So actually, I got that wrong. So this was the time period where they announced they'd bought their 5% stakes, Ode and also JP Morgan. So it's quite conceivable that this massive leg up here was them buying all those shares because it accounts for 10% of the company in total. So I think it's fairly reasonable to estimate that this is the price that they paid. It's been going up and down up to 10% each day, but it's currently trying to decide what it does here. So yeah, it's certainly very interesting to see some big names like this buying in quite recently. Some of these players obviously are banking on Liz Truss to do her work by restarting fracking in the UK. The shareholder story is quite positive for IGas. Then looking at the sector analysis, and the general trend for oil and gas is this linear channel up, which I attribute to GDP increases in the world over time as the world develops, and the more GDP there is, the more oil needs to be burnt because oil is a critical part of human civilization and progress, as well as all other energy sources, of course. But the more that civilization progresses, the more energy you need to drive that. However, we had the credit crisis, which explains the sharp drop, but it then still stayed in trend. And this here is like an anomaly, which is quite easily explained by the OPEC shale war. And that's where the US started its shale industry around this time, around 2015. And so OPEC obviously hated that. So they deliberately overproduced to force the price of oil down so that the shale producers who have to produce at a higher cost couldn't actually economically produce their shale oil and gas. And so this was the OPEC shale war, which artificially dropped the price. And then it obviously, when they kind of gave up eventually, it raced back up again. And then we had the Wuhan flu crisis. This then seriously dropped the price of the oil and gas sector. But actually, this was also a bit of a double whammy because you had really low oil prices in 2020, but then also this was where the hatred of oil and gas was at its heights. Governments were pledging trillions of dollars into green energy and saying, there'll be no more cars on the road, and we're going to basically get rid of oil and gas and move to green energy. And so all of the asset you had a double whammy of the Wuhan flu and then also all of these asset managers running out of the oil and gas sector because it was so unfashionable. This, by the way, this green thing, that's when I actually invested in oil and gas myself by buying initially BP, which I then sold and converted into Shell and Total Energies. But that was when I started my bet on oil and gas. I think that this shoot up is obviously we then entered into an energy crisis because of those government policies and also the lack of investment in oil and gas led to a decrease in production and development. So you get a supply and demand dynamic, and then really high oil and gas prices caused by the government. And so then it makes sense for the prices to then shoot back up to the normal trend, assuming that the world continues to grow at its historical pace. So from here, though, it's one thing when you're investing down here, but here, is this a good time to be investing in oil and gas in the oil and gas industry? And that's obviously a decision every individual's got to make. But I certainly wouldn't be now. I mean, IGas is a risky bet, asymmetrical bet, so it's kind of different for my situation, and I'm only going to invest a tiny amount of what I normally invest because I'm doing it just as a bit of fun, really. But if you're investing serious money, or if I was looking into IGas as a stock to invest in, like I do most of the analyses that I do, here it could go either way. Either we do revert back to the normal trends, which would be related really to oil price, oil prices of say uh, oil prices of above $80, say, for a sustained period of time, or we do enter into a worldwide recession and last several years, in which case you could see oil price dropping to $60 a barrel or whatever, and you could see this drop. I mean, actually, an important point to remember is I've looked at Shell and Total Energies, look at my videos on them, and their future planning is all for $60 oil, $70 oil. I think $70 oil now, they upgraded it. So they'll be making profits and all running fine at $70 oil. So with the energy crisis, can you actually see it dropping below 70? I'm not sure. If you don't, even in a recession, if you don't, then it probably is going to go back up into this channel. If, however, there is a really, really bad worldwide collapse, oil price drops down to $30, then that would be the end of this long-term trend, and you'll see it crashing back down. So obviously that's looking at the sector, it's kind of, you could say it was a neutral, it was indicating a neutral stance at the moment. It could go up, could go down. So IGas really need to be considered a zombie company. I think they might even make some money this year, but the problem is they rely on an energy crisis rather than being able to make money at more historically normal oil prices. Certainly, when I look at the long-term oil prices, there were sustained periods at above $100 a barrel. So that could be the case, but really, it definitely looks like a real eyesore, their books, and you've got to really say that their finances are a bit of a mess, and the quality of their assets is poor. They're priced the same as a Shell or a Total Energies, despite them having a much poorer profile than those companies do when you look at this similar statistical treatments. Yep, so they're definitely to be considered a zombie company as they currently are. Great potential of astronomical future upside if Liz Truss does her thing, and then if it's actually technically possible to extract shale in the UK. I kind of had some strange emotions when I was considering investing in them while I was actually doing my preparation for this video as well. I'd actually been looking at them around here and back and around here, so I missed the opportunity to buy them when obviously was the right time to buy them. So I had that emotional aspect that's probably unhealthy. I always hate going in when it's just done this. But for me, the actual potential upside for here really is such a nice asymmetrical bet that I was almost going to buy him. And then when the RNS came out that JP Morgan Chase had just bought up 5% and it's now 6% of the company, that was the final thing. I thought, I'll take a bet on this. But it really is a high risk bet, it has to be said. And my plan is I've only invested a quarter of what I normally invest in the stock, so it's only a small bet for me. And my plan is if they do say 5x or 3x or something, I'm waiting for Liz Truss to get an act through Parliament, a Emergency Energy Act or something, which then stops the local authorities from banning the fracking by not giving planning permission. And then when there's like this act of Parliament, that's when I then plan to sell probably 60% of my shares, maybe more, and then I'll hold on to the rest in good profit, or anyway, whatever happens, I'll then hold on to the rest and then just enjoy what happens next. But I think it's important that you sell. But I think it's important that you sell most of your position before the fracking actually starts, because when the fracking actually starts, then that's when you've got dangers of earthquakes and things. I've just realised I forgot to do the statement of cash flows. Here it is. It looks absolutely terrible. They're losing 12 million from normal activities, and their income, 10 million of their income was exploration write-offs. So yeah, really nasty looking statement of cash flows there. So to summarize, they might make a profit in 2022 based on the oil price if you take away the 10 million exploration write-offs that happened the previous year. The thing is, though, it's bad to be relying on an energy crisis just to break even, compared with Shell, where the energy crisis is just a massive bonus. In my opinion, they should be considered a zombie company relying on a energy crisis to break even. Much of their current assets are low quality as of the current status quo for Shell. So I think they're hideously overpriced versus blue chips. Of course, the reason why they're valued as they are is because of the speculation that Shell is going to be given the go ahead because of the energy crisis. There's going to be an absolute maelstrom of long-haired, upper middle and upper class protesting against fracking. There's going to be loads of protests that you'll see on TV. This is going to be just like Margaret Thatcher against Arthur Scargill and the miners. Only this time, instead of going against the miners, it will be long-haired protesters. You're requiring Liz Truss to be able to get through all that and get an act through Parliament to force the local councils to allow the drilling to take place. And you're also relying on Shell being actually possible in terms of UK geology, which is an unknown as of now. So there's two big ifs here. However, if those two unquantifiable prerequisites happen, the upside is absolutely breathtaking. So don't try this at home, but if it moons, make sure you sell before the fracking actually starts. The key risks for long-term holders are that fracking is not feasible in the UK due to geology or earthquakes. Although to be fair, the earthquakes seem a lot less likely. IGas are going to be drilling. I should add that now. There's a significant drop in oil and gas prices due to a global recession and bankruptcy. To be fair, though, that's probably more 5 to 10 years off than immediate at current oil prices. And actually, bankruptcy is probably going to be long-term delayed as long as we have high oil price. So that completes my video for IGas. I hope you enjoy it and play safe with your own investing. Please read the disclaimer. Remember that prices can go down as well as up.